Every generation believes it has discovered the secret to timing markets, a signal, a ratio, a pattern that finally explains when to buy and when to sell. And every generation, markets remind them that timing is not a formula, it is a temperament tested under pressure. Financial celebrities who endured multiple cycles learned this lesson slowly, often painfully. They did not master cycles by predicting them, they mastered themselves within them. Market cycles are not mechanical clocks. They are emotional tides. Expansion and contraction are driven less by data than by belief. Belief in growth, belief in safety, belief in inevitability. Books that chronicle decades of investing reveal a consistent pattern. Prices move because narratives move. Fundamentals matter, but sentiment decides when fundamentals are ignored or worshipped. The first mistake most investors make is searching for precise turning points. Financial celebrities abandon this search early. They realize that tops and bottoms are only obvious in hindsight. In real time, they are messy, frightening, and ambiguous. Waiting for certainty means arriving late. Acting too early means enduring discomfort. Mastery lies not in perfect timing, but in positioning. One of the clearest insights from those who survive cycles is that buying and selling are asymmetric acts. Buying requires courage when pessimism feels justified. Selling requires restraint when optimism feels rational. Most people reverse this. They buy when reassurance is abundant and sell when fear becomes unbearable. Financial celebrities invert this instinct not by being fearless, but by being prepared. Preparation begins with understanding where the market sits psychologically, not numerically. Valuations alone do not signal peaks. Cheap prices alone do not signal bottoms. What matters is expectation. When future returns are assumed rather than debated, risk is high. When despair dominates conversations and patience disappears, opportunity emerges. These signals are qualitative, not quantitative. Another critical lesson concerns time horizon. Financial celebrities align buy and sell decisions with the duration of the cycle they are exploiting. Short-term traders fail at long-term cycles. Long-term investors fail when they behave like traders. Mastery requires coherence. If you are investing for a decade, daily noise is irrelevant. If you are trading volatility, macro narratives are distractions. Confusion of timeframes is a silent killer. Liquidity also plays a decisive role. The ability to buy when others cannot is the real edge. This is why financial celebrities obsess over cash during good times. Cash is not a return drag, it is future optionality. In late cycle environments, they build liquidity quietly, not because they know when the turn will come, but because they know it always does. Selling, however, is where mastery is truly revealed. Buying well feels clever, selling well feels lonely. Financial celebrities sell not when prices stop rising, but when upside becomes fragile relative to downside. They sell when stories require perfection to continue. They sell when leverage replaces prudence. They sell incrementally, without drama, often long before headlines change. Another pattern emerges around humility. Financial celebrities do not aim to capture the entire move. They accept leaving money on the table. This acceptance protects discipline. Those who insist on catching the exact top or bottom usually catch neither. Partial victories compound better than heroic failures. Market cycles also punish those who confuse volatility with risk. In early downturns, volatility spikes before fundamentals collapse. Selling here locks in fear. Financial celebrities differentiate between price movement and permanent impairment. If the business survives, volatility is noise. If leverage threatens survival, volatility is a warning. Knowing the difference determines when to sell and when to endure. Narratives evolve predictably across cycles. Early optimism focuses on innovation. Mid-cycle confidence focuses on growth. Late-cycle euphoria focuses on inevitability. At the bottom, narratives turn moral blame replaces analysis. Financial celebrities listen for these shifts. They do not trade stories, but they respect what stories reveal about crowd psychology. Another overlooked element is personal cycle alignment. Financial celebrities adjust aggressiveness based on their own stage. Early careers tolerate volatility. Later careers prioritize preservation. The same market condition demands different actions depending on personal context. Mastery requires self-awareness as much as market awareness. Books also show that financial celebrities rarely act alone at extremes. They prepare alone, but execute with structure. Checklists, predefined ranges, staged entries and exits. This structure prevents emotion from hijacking timing. Decisions made in advance are easier to execute when fear or greed peaks. Importantly, financial celebrities do not confuse activity with mastery. Many cycles pass without action. Waiting is a position. Inaction preserves capital and clarity. The greatest returns often come from a handful of well-timed decisions across decades. The rest of the time is spent preparing not to make mistakes. Another insight emerges around regret management. Financial celebrities design strategies they can live with psychologically. They prefer being approximately right with peace of mind over being precisely right with regret. This psychological sustainability allows consistency across cycles. As cycles repeat, one truth becomes unavoidable. Markets do not reward those who know what will happen next. They reward those who remain solvent, patient, and rational long enough to act when opportunity finally appears. Buying and selling are expressions of character before they are expressions of intelligence. And this is where the story begins to narrow. Because once we stop asking for the perfect signal and start building the emotional and structural capacity to act when conditions are merely favorable, not perfect, the mastery of market cycles becomes attainable. It is at this point where discipline replaces prediction and preparation replaces urgency, that the timeless lesson from financial celebrities crystallizes. Successful buying and selling are not reactions to markets, but responses to one's own readiness, unfolding across cycles not through bravado, but through restraint, liquidity, humility, and patience, as the real edge reveals itself slowly, only to those willing to wait through boredom, endure discomfort, and act decisively when the crowd cannot, like a tide that rewards those who prepare their footing long before the water turns. And this is where mastering market cycles finally becomes clear, not as an act of prediction, but as a discipline of positioning, restraint, and survival. In the second half of this lesson, financial celebrities converge on a sobering realization. Most people do not lose money because they buy too early or sell too late. They lose money because they are forced to act at the wrong time, forced by leverage, forced by lifestyle, forced by fear. Mastery of market cycles begins not with charts, but with removing the conditions that eliminate choice. This is why the most seasoned investors design their lives to reduce urgency. They keep expenses low relative to capital. They avoid leverage that demands constant correctness. They build buffers, financial, emotional, and reputational. When markets turn, they are not scrambling. They are observing. Observation is a privilege only available to those who are not under pressure to act. Another crucial insight is that cycles are rarely symmetric. Bull markets climb on optimism, but bear markets fall on liquidity stress. Prices do not drop simply because people change their minds. They drop because people must sell. Financial celebrities pay close attention to where forced selling is likely to come from. Margin debt, refinancing walls, weak balance sheets, overextended consumers. These are not timing tools. They are fragility maps. Buying, in this context, is not about bravery. It is about preparedness meeting mispricing. Financial celebrities buy when pessimism is high and survival is assured. They do not buy simply because prices are down. They buy when prices are down and they can hold through further pain without being compromised. This distinction separates intelligent contrarianism from reckless gambling. Selling follows a similarly disciplined logic. Financial celebrities sell not when fear appears, but when complacency dominates. They reduce exposure when leverage is celebrated, when risk is disguised as innovation, when narratives dismiss downside as outdated thinking. Selling is framed as risk reduction, not profit taking. Profits are a byproduct of survival, not its goal. Another key lesson emerges around scaling decisions. Financial celebrities rarely go all in or all out. They scale. They buy in stages as conditions worsen. They sell in stages as conditions improve. This staged approach reduces emotional load and regret. It acknowledges uncertainty instead of denying it. Mastery accepts that you will never know everything and plans accordingly. Cycles also teach the importance of memory. Financial celebrities keep mental and often written records of how cycles felt, not just how they looked. What did optimism sound like last time? What excuses were used? What was dismissed as impossible? These memories become pattern recognition tools. History does not repeat exactly, but it rhymes loudly enough for those who listen. Another overlooked factor is social pressure. Near market extremes, being right feels lonely. Buying when others are fearful invites criticism. Selling when others are euphoric invites ridicule. Financial celebrities prepare psychologically for this isolation. They value being early over being applauded. They accept that validation usually arrives after opportunity disappears. Personal temperament again plays a decisive role. Financial celebrities do not adopt strategies they cannot emotionally sustain. A strategy abandoned mid-cycle is worse than no strategy at all. Mastery means choosing approaches that align with one's patience, risk tolerance, and attention span. There is no universal right time to buy or sell, only times that are right for you given your structure and temperament. As cycles repeat, another truth hardens. The biggest mistakes happen not at extremes, but during transitions. When confidence quietly turns into complacency, when fear quietly turns into despair, these gray zones are where discipline matters most. Financial celebrities remain most alert when things appear fine. Comfort is often the final warning. Over decades, the lesson becomes almost boring in its consistency. Those who survive cycles do fewer things, more deliberately. They hold cash when it feels unnecessary. They reduce risk when it feels premature. They act when it feels uncomfortable but not unbearable. This calibration is the essence of mastery. And so the story resolves into a principle that resists simplification. Knowing when to buy and when to sell is not about knowing the future. It is about knowing your position within uncertainty. It is about ensuring that when opportunity appears, you have the liquidity, patience, and emotional control to act. And when danger builds, you have the humility to step aside without regret. If this reflection resonated with you, pause and ask yourself one question. If markets moved sharply against you tomorrow, would you still have the freedom to wait? That answer determines whether you are mastering cycles or being carried by them. Share your thought. And if you want to keep learning how the most resilient investors think across booms and busts, stay connected. Subscribe, follow, and return. Because markets will always cycle, but only those who design for survival get to choose when to buy, when to sell, and when to simply do nothing at all.